Greetings, everyone. So it's Employment Friday without the employment report, of course. The U.S. government is effectively, for the most part, shut down. Lest you worry, and this has been all over the media, it is very interesting to know that the stock market usually goes up while the government is shut, for whatever reason. Anyway, we do have a lot of statistics to discuss. I think since the last In the Know, we got the huge revision in employment. It was 911,000 jobs fewer in March 25 than had been originally reported. So we had been showing you consistently monthly revisions which were down. And of course, the total was almost 1 million. The Fed did cut the Fed funds rate by 25 basis points. They are still balancing between inflation, which once again seems stuck because tariffs are working through, so stuck in the 2.5% to 3% range for the most part, against employment, which is beginning to deteriorate. We did get this week the ADP payroll report. This is from the private sector, and the number there was -32, and perhaps more important, the previous month was revised down from +52 to -3,000. That's unusual in the ADP survey. So employment is weakening, and probably more significantly than we understand. There are a couple of reasons here. One, of course, is cyclical. Employment is a lagging indicator. We've been talking about a rolling recession for the past 3 years, and we've started moving past that in terms of at least our understanding of what is unfolding, into the thought that we may be going into a rolling recovery, which we think next year will evolve into a productivity-driven boom in activity, just in time for the midterm campaign election season. I don't think that is a coincidence. I think the Trump administration has taken or given a lot of tough medicine very early in its term, and that it is looking forward to a very exciting next 3 years. But the Fed is grappling here. Employment down, inflation sticky. And so we're once again in that, are they or are they not going to cut rates again? We think they will. And one of the other reasons is not only is private employment falling, but we know government employment is falling. And we believe between now and the end of the year, another 150,000 jobs will be lost in the federal sector. And it could be even more than that, because with this shutdown, it seems like the administration is doing more, I think, what it would call house cleaning, to increase the efficiency of government and get spending under control. So that's the big picture. I will now go into the usual drills, so fiscal policy, monetary policy, economic indicators, market indicators, and weave in there a little bit about innovation, because innovation is causing a bit of a stir on the employment front, and I will show you quite a provocative chart in a few moments. Okay, with that, so we'll start with fiscal policy, and you've seen these charts before. Our confidence that the deficit is going to diminish as a share of GDP to at least 3% of GDP, which is Treasury Secretary Bessent's objective by the end of the Trump term. If we're right, and the growth rate in the next 3 years is much stronger than anyone has forecast, we believe that the deficit could shrink to less than 3% as a percent of GDP. So that we think is good news, and we are seeing month to month now declines in the deficit very recently, as you can see on this chart. Now I'm going to bring up this next chart because having been through Europe and Asia in the last 5 weeks, it is very clear that the rest of the world has been influenced by headlines and drama and negative headlines, and they know nothing of the good news in what we are now calling OB3, the One Big Beautiful Bill. So in OB3, and I've shown you this chart before, but you know, the more I think about it, the more provocative this is. So we have never in our history seen a policy where for manufacturing structures built in the United States during the next 3 years, or in the process of being built, depreciation will not be over 30 years, as it typically is. It will be 1 year, fully expensed. In fact, the government will be refunding a lot of companies for the manufacturing structures. They'll be getting refunds for how much they have spent relative to what has been expected to be their tax bill. So that is just for the next 3 years. The next 3, equipment, domestic R&D, and software, music to innovation's ears, those are also fully expensed in year 1, and these have been tried on and off by various administrations when they're trying to stimulate the economy in the short term, but they have never been legislated in to be permanent, and they are. And, you know, I actually have to do a double take every once in a while. And for that reason, what you're seeing here is while the statutory tax rate will stay at 21%, that's, in fact, President Trump in his first term got that down from 35 to 21%. How he did that, I will never know, given the divide in government. But now what we have is an effective tax rate when you take into account the depreciation that I've just mentioned, dropping towards 10%. We thought originally it was going to be 14%, then 12%, but it looks like it's dropping towards 10%, which would put the U.S. tax rate at really one of the lowest in the world, lower than Ireland. I think Ireland's still at 12 or 12.5%. I was looking at the Hong Kong rates. It's well known for its very low tax rates, and we're below, for larger corporations, the Hong Kong tax rate. And we do think that this is going to invite a huge amount of foreign direct investment. And we think we'll see a manufacturing boom in the United States for the first time really in, I'm going to say, 30 years. 30 years. The rest of that time, certainly since China went into the WTO in the early 2000s, manufacturing has been effectively gutted from the United States. So this is going to be a real turnaround, and we do think that this manufacturing, while of course it's going to increase employment to some extent, it is going to be highly automated with AI, robotics, humanoid robots, and other robots. And we're probably going to become a more efficient manufacturer than China. At least from a unit labor cost point of view, because we will be so much more automated. China built up its manufacturing infrastructure in the last, well, really it was in the early 2000s. So that now is dated. And of course, they are investing aggressively in robotics as well. They have to, especially for demographic reasons, but they also have a lot of sunk costs in their existing manufacturing infrastructure. So we do believe that for this reason, the return on invested capital in the United States is going to increase relative to that in the rest of the world. And this flies in the face of conventional wisdom because most investors, strategists, others think that the dollar has lost it. The dollar is probably going to go up if what I just said is correct, if the returns on invested capital in the United States go up relative to those in the rest of the world. So stay tuned for that. Now on to monetary policy. Here we've presented this chart before, and you can see M2, the year-over-year growth rate, has accelerated. It was dropping at a 5% rate in 23-24 on a year-over-year basis, and now it is up 5%. And you can see still really in the middle of the historical growth rate. You can also see the CPI in green here. Again, a little stuck in the 2.5% to 3% range. But when we think about how large the tariff increases have been, and we see just a stuck rate, I think that's a better than expected outcome. And one of the reasons, according to surveys that we've seen, is businesses are eating the tariff increases more than consumers are. And it is forcing them into more productivity-enhancing measures, which of course means automation and AI. So their margins have not gone down as much as we would have expected. So that's a little bit of a win-win, if there is one in this situation. As I've said, I'm not a big fan of tariffs at all. They are regressive tax increases. But if you give me the choice between tariffs with the tax changes that I just discussed and the massive deregulation that is taking place under this administration, that trade-off is going to be worth it. For the reasons I just said in terms of returns on invested capital here in the United States. So we think that the resolution here is going to be that the CPI will drop next year. Many people, when I use the word productivity-driven boom, when I use the word boom, they think, okay, a boom means more supply chain problems and more inflation. That is not what we mean at all. In fact, the history, if you look over the last 45 years, the history has been the stronger the growth rate, the lower the inflation, especially if it's a productivity-driven growth. And we think that's exactly what we're going to see. So we wouldn't be surprised to see the green line here veer back towards zero. And as you see, there have been other times when it's been at zero. One was a very bad time. That was 08-09. And one was right before COVID really caused the supply chain problems. So we have been veering over the last 10, 15 years towards that 0%. And I think that will be the big surprise next year. Now, I have been saying this for a while. The supply chain shock it took so much longer to work through than we expected. And of course, now we have tariffs. So one excuse after another. But I don't think there will be an excuse next year. Now, here is trueflation. Again, this is a real-time measure of inflation, consumer prices. I think there are tens of thousands of goods and services priced in real time. And you can see here another indication that inflation is not being pushed up much, if at all, by tariffs. And as we digest the tariffs, we think the resolution here in terms of this recent basing of inflation is going to be to the downside and towards that 0% mark. Now, one of the things that we're really focused on, as we've been discussing for actually a long time now, is the velocity of money. And we've been expecting, with all of the uncertainties, tariffs and so forth, that people would become fearful and pull in their horns from a spending point of view. And they are beginning to do that. That usually means the velocity of money falls. So the velocity of money is in the green line here. And we have mapped it against the participation rate, the labor force participation rate. It's the only metric that I have seen that correlates with the behavior of velocity since it peaked in 1997. So we've been expecting with the tariffs and employment disappointments, we've been expecting the consumer to become more conservative in spending. So the velocity of money in that case would roll back over and start falling. Well, it has flatlined. It hasn't quite done what we thought, but it is no longer going up. In other words, it's not turbocharging that money growth. That 5% year-over-year growth in money, if velocity is flat, means nominal GDP will be roughly 5%. If money growth slows down here, or if velocity rolls over, then nominal GDP growth will be below 5%. So let's see what happens. So far, we're in a bit of a balancing act. We didn't expect that. That's what's happening. And I'll go into why in a moment. In fact, in a very short while. Here, though, is a measure of the yield curve, so longer-term rates minus shorter-term rates, in this case the 2-year Treasury yield minus the 3-month Treasury yield. And when it's below zero, that means that monetary policy is typically erring on the tight side. The Fed is too tight, too restrictive. And you can see in the past, when it has reached this kind of level, we have typically been close to, if not entering, a recession, as shown in the shaded area there. We haven't had a recession, but as you know, we've been calling the last 3 years a rolling recession, which is consistent with where this measure of the yield curve is. This measure of the yield curve suggests that the Fed should continue to cut rates 1, 2, 3 more times. But if we're right, next year the Fed will stop cutting rates if we're right on the productivity-driven boom in activity. For right now, though, this metric suggests the Fed should continue to cut rates. Now, this is another measure of the yield curve, and I am watching this quite carefully because of what we noticed in COVID. We noticed that despite the fact that governments around the world, from a monetary point of view and from a fiscal policy point of view, we're just throwing money at a problem that, seemed likely to throw the global economy into a depression. They certainly averted that. But there was so much stimulus, I would have expected this measure of the yield curve and the steepness of it to move into where it was in the 08-09 period. It did not. What does that suggest? One of our hypotheses is that the bond market, in its wisdom, does see the deflationary undercurrents that are at work in the economy today. A lot of them because of technologies. And I haven't done this in quite some time, but to give you a sense of the deflationary drama, this is good deflation. When you cut the price of a technology, it will increase in terms of unit growth. But to give you a sense of the deflationary drama out there, for every cumulative doubling in the number of industrial robots produced, costs will decline by 50%. That's called Wright's Law, and we've centered our research around it. In the electric drivetrain space, that's the largest expense in an EV. For every cumulative doubling in the number of those produced, costs decline by 28%. DNA sequencing, for every cumulative doubling in the number of whole human genomes sequenced, costs decline by 40%. And AI, for every cumulative doubling in a metric that we have devised, it's a metric involving data per unit of computing power. For every cumulative doubling in that, costs, both hardware and software, drop by 48%. But the astonishing thing is those costs, that cost decline is happening in less than a year's time. The cumulative doubling is happening in less than a year's time, so that AI training costs are dropping 75% per year. AI inference costs are dropping 85 to, if you believe DeepSeek, 98% per year. Astonishing declines. And we think that this measure of the yield curve, in its wisdom, is onto that. We shall see if the Fed continues to ease and this measure of the yield curve does not surpass where it was in COVID, right after COVID, then this downtrend will be in place, and our conviction in what I just said will increase significantly. On this page, you can see, again, real GDP and how importantly productivity influences it. Now, productivity in this rolling recession is still in the 2 to 2.5% range on a year-over-year basis. That is very good. What has kept real GDP growth up until recently has been government spending and spending in government-related sectors, education and healthcare, importantly, among them. We're losing a lot of those growth vectors to changes in policy, of course, and the other variable holding this GDP growth rate up, and GDP is in the purple here, has been really the high-end consumer. Almost every other sector has been under duress, with the exception of capital spending associated with artificial intelligence, so data centers and power sources and so forth. So that's what's kept GDP up. If we're right, GDP growth could slow a bit more, but will turn around, and we will enter into a real growth trajectory driven by productivity in the 5% range. And we believe that in that range, 5% plus or minus, that unlike in past recoveries, it will be sustained. You can see in the past, when productivity has recovered, usually after a recession, it settles back down. This time, we don't think that's going to be the case. So stay tuned for that. On the next page, you can see where we are right now in terms of manufacturing and non-manufacturing activity. So non-manufacturing is in green, manufacturing in purple. And you can see manufacturing activity has been negative for roughly 3 years. That's what we mean by the rolling recession. And even non-manufacturing, is beginning to suffer. It just dropped, I believe, to roughly 50% in the latest reading. And I think that was a September reading. So we're not really seeing a lot of growth from these two areas right now. You can see on the next chart that, and this is a very new report, it just came out today. Here you can see the ISM for services, so non-manufacturing, but a broader take at it, dropped back to 50. And I should have explained, 50 is the demarcation point between expansion and contraction. So ISM for services, the new orders, which is in green, slipped back to 50, meaning there's really no growth. You can see prices paid around that 70 mark. So those prices are still going up. But notice what I just said. Activity down, prices up. Companies try and make up for weak activity with pricing, especially as they're facing tariffs. And a lot of the manufacturers who report in the survey mentioned tariffs, that the tariff cost increases have intensified, and they're trying to get those costs passed through into pricing. And we'll see if they are successful. One of the reasons orders have relapsed, we believe, is because they are trying to get prices through. And the consumers of these products are basically saying, no, you'll have to cut your prices. So again, stay tuned on that one. And it's important because this is the services sector. Now here you can see we're going into employment. While we didn't have a report today, we want to lend some perspective to what's going on out there in employment. So in the green is the monthly unemployment rate. Now, it is being held down, we believe, by baby boomers retiring, about 1.3 million per year, and immigrants leaving because of our government policies. And then longer term, it's low fertility rates. What you see in the purple is the unemployment rate for recent grads. And you can see in this rolling recession, that unemployment rate has gone up from roughly 5 to 6.5%. And it's going up for a couple of reasons. One is cyclical, as I just mentioned, but the other is because of technology. AI in particular is starting to limit the increase in entry-level jobs. We don't need as many new research associates as we might have needed, given that we've started up new products and so forth, because we are automating. We're using Palantir, and we're all vibe coding. I'm not going to tell you I'm doing a lot of vibe coding myself, but I've dabbled with Replit, and it's really empowering if you have the time to do it. So you can see on this chart, the quit rate has gone down, is going down, and is where it typically goes during a recession. People do not quit their jobs if they believe they will not be able to get another one. And the duration of employment, I think I have this in this pack here, the duration of employment, yes indeed, is going up. It's gone from roughly 20 weeks at its low recently to 25 weeks. But take a look at what's happened over time. There's something structural going on. The 20 weeks is where it used to peak. And in the early 80s, before we entered Reaganomics, or as we were entering, it bottomed at 10. So now it's bottoming at 20, so and moving to 25. That's a half year. So when a person loses a job, he or she, on average, has to wait almost half a year for a new opportunity. These are all averages, of course. This is not true for everyone. I do think this move towards automation is exacerbating this trend right now. And here you can see it in living color. So here is U.S. job openings. We did get this number. The job opening number continues to come down. But take a look at what happened after ChatGPT was released. We had been in, again, supply chain issues, tough to get labor back during COVID and after COVID. But now the number of job openings is continuing to decline. And normally when it has declined this much, we are in a recession. The counterbalance here, of course, is if companies are not hiring and are harnessing AI and other productivity enhancing tools, their margins are not suffering. And that is one reason capital spending, ex-AI, it has been weak, but it has not collapsed. So companies know they have to invest. So it's been a very interesting cycle, to say the least. Here is another surprise to us. Here's the personal saving rate, and you can see what happened during COVID. It skyrocketed to record highs, and then went almost immediately to near record lows. And we thought that as we moved through this rolling recession, that more and more people would fear for their jobs and the saving rate would go up. Why has this not happened? Well, one of the reasons is there are a lot of people living hand to mouth out there, so it's not possible for many people. But for higher income consumers, what has happened in the last few years? Well, the stock market has continued to go up, and home prices have gone up. They have not gone down, even though so many other measures of housing have collapsed. The pricing is up there. I think it's up there because the market isn't clearing, and we'll go into that in a moment. I guess we're here. So, home buying intentions. The intention to buy a house is pretty high by historical standards. This chart goes back into the 60s, and it has been very high since the 08-09 debacle and recovery. So there is a big imbalance out there. There are a lot of young people who have not bought a home. They've been shut out for all kinds of reasons. Affordability, of course, is a big one of them. And so while they might have the intention to buy a house, here's what they're saying about buying conditions for houses. Is this a good time to buy a house? No. In fact, this is one of the worst times ever. And, ever includes back in the 70s and early 80s when we were at double-digit mortgage rates. Double-digit meaning 15% plus. So they're feeling, from an affordability point of view, that now is not a good time to buy a house. Why? Well, the housing market houses are populated today by people who probably have very low mortgage rates. Interest rates were very low, near zero of short-term interest rates for years. And so many people have a 2.5–3% mortgage rate. Well, mortgage rates, even after the recent decline, are more than double that right now. So many people, even if they want to move, they're trapped in their homes. They know if they move, their mortgage rate will double and their payments will roughly double, and they just can't afford that. Here you can see, therefore, what has happened to pending home sales. They're very low. Now we're seeing some flickers here. In fact, new home sales jumped 20%. I think that was in August. And that was people capitalizing on, the drop in mortgage rates from 7-ish% down to 6.3%. So there are some people that just have to move. And so we are seeing, shall we say, stabilization, albeit at a very low level. On this next page, you can see both new and existing home sales. This is the volume. That uptick at the end there was all that new home sales volume I mentioned. Existing home sales are moribund. And, it is shocking to me. I remember, I started in the business I was in college in the late 70s, and not mortgage rates. Well, of course, they were in the double digits, but home sales back then were roughly where they are now, which is shocking. The population is much, much bigger now, and yet home sales are back where they were 45 years ago. It's really crazy. And here's another problem. Here are new one-family houses for sale. Now, builders are carrying this load. This is becoming inventory, and it's painful. They are going to have to cut prices if they really want to clear these. Now, they have been doing it surreptitiously by buying down mortgages. So it's not showing up in the home price necessarily, but in the package deal, the builder is accepting some of, or basically giving a rebate to offset some of the mortgage rates. We're not seeing that in pricing, but that is effectively a price decline, and we think we'll see more of that. Here are prices, and you can see existing home sale prices are in the green. New home sale prices are in purple. Those are falling, so there is a little bit of clearing for that reason as well. The mortgage rate coming down 75 basis points or so, and prices declining. And they have been declining, this is what I mean by a rolling recession, for 3 years. So it's declines upon declines upon declines. That's on the new home sale. Now existing home sale pricing is beginning to capitulate. It's not below zero yet. This is a 3-month moving average, but it seems to be headed in that direction. And what's really important to know about this slide is these declines, especially if existing home prices continue to veer towards zero, this is going to be baked into the CPI for the next few years. There's a big, big lag. So this is going to be a depressant on CPI inflation during the next few years. We think oil prices will as well. And of course, we think technology will as well. So a lot of anti-inflationary forces. And of course, the most potent one of all is productivity. Productivity offsets wage gains. And that's very important for corporations. Or any company. Here you can see we're into capital spending. Non-defense capital goods, ex-aircraft, it was in a slump. It was part of the rolling recession. This recent uptick is all about data centers and data center related activity. The rest of capital spending has been going down. Again, the rolling recession. We think this is going to turn around dramatically now, and it is for the reason I stated at the beginning, the new depreciation schedules, the new incentives to invest, so we're pretty excited about that. Now, I want to give you some perspective. This first one, real structures. Real means adjusted for inflation, activity adjusted for inflation. So this is a component of CapEx. Now, it says data centers here, and it's a little more involved than just data centers, but data centers have been powering this particular line item. You can see this was going nowhere post-COVID, and then we had ChatGPT. And then starting in late 22 to now, we've seen a 2.5-fold increase in real structures associated with data centers. So this is a boom. And here you can see on a year-over-year growth basis, interestingly, the real burst was in 23 and early 24. We peaked at around 75%, and now we're in the 35% range. Now, it seems like we're going through another wave, given recent announcements from OpenAI, NVIDIA, Stargate, so Oracle, and others. So let's see what happens. 35% is still a pretty heady growth rate. Now, here is real manufacturing structures, all, including the data centers. And you can see this had, in response to the supply shock that we got around COVID, we did see a burst in manufacturing structures being built. That has rolled over, and you can see the growth rates here. That growth rate peaked at over 50% and is now down to, well, it's actually negative on a year-over-year basis. This is what's going to change dramatically. And as a percent of all manufacturing structures, data centers are up to 18%. They have doubled as a percent since late 22. And we think they probably are not going to go too much higher, maybe 20%, because the rest of manufacturing is now going to move into a very strong period as foreign direct investment is attracted here, and capital spending by local companies is incentivized by our new tax regime. Here's the trade balance. It's improved dramatically, of course, but we've had a wild swing around tariffs. There were huge imports before the tariffs. Now we've had a drop-off in imports, but I will say, I do think President Trump might be disappointed by this one, given the way he's thinking about trade. He thinks a deficit is bad. A trade deficit is not bad. It's the other side of a capital surplus. And as I just mentioned, we think there's going to be a lot of foreign direct investment and a lot of importing, therefore, into the United States, more than expected. Now, here we're going into market-related indicators, at least some. Here's the dollar. I know I featured DXY, which is against 6 countries, and that has been weak. This one is the one to keep our eye on, especially given the way the Fed thinks about things. This is against 26 countries, again, trade-weighted. And here you do not see the collapse in the dollar that was making headlines. Worst first half of the year since 1973, which on the DXY was true, not on this metric. So again, better to have a more complete picture than an exaggeration based on a narrow sample. Here you can see the S&P 500 earnings per share expectations for the next 12 months. And you can see they continue to go up. Part of that is the dollar. It has helped our multinationals in terms of in terms of their revenue and profit dynamics. But we also do believe that corporations are working diligently to increase their productivity already during a rolling recession. That is when innovation gains traction. When consumers and businesses are afraid of the future, they change the way they do things. And we think that is happening now to the benefit of innovation. Here are some more market indicators. Commodity prices, flat, you can say, for the last 45 years. I know there's a lot of volatility But recently, not so much volatility, which is very interesting, given the volatile policy metrics out there, measures. This is our metals to gold ratio, so metals price to gold price. I continue to believe that somewhere in the world, something is not right. And we've been saying we think it's China. We think the deflationary bust there is worse than the government is reporting. That could be wrong, but we can't figure this one out. The gold price has been very strong, and it has been, many people are calling it the debasement trade. Both gold and Bitcoin have been strong on balance. Gold recently much stronger than Bitcoin. So there's definitely fear of something out there. Maybe it's not the deflationary bust in China, although I still look at 40% investment relative to GDP in China as way too high. Sure, they're building 28 nuclear plants, but 40% of GDP, that is not. There is a lot of other investment going on in China, which might be exacerbating the deflationary bust in property that they're experiencing. But then again, in terms of gold prices going up, I mean, our policies are bringing about some of that. The geopolitical risks, tariffs, the visa program that was announced this month. A lot of people are saying, I can't figure this out. And as I said, I've been around the world in the last 5 weeks, and I think a lot of people are very negative on the U.S., and I've just given you a bunch of reasons why we are not. But I do understand why they're negative, because the headlines are so stark, and they're not picking up what's going on underneath. I think President Trump is a maestro at distracting with a lot of drama and then getting the job done. That happened in his first administration, and I think it's happening in this administration as well. Nonetheless, people are saying, I'm going to lower my exposure to the U.S. Gold is my hedge. It's an insurance policy, and so forth. And it may be why our interest rates have not come down, for the same reason. Governments and individuals abroad lowering their exposure to the U.S. Now, I think that will reverse, again, for reasons I suggested, but I do understand why we're seeing what we're seeing. Copper, the trend is up. Here we're seeing more of a supply shock. In Indonesia, I think one of the largest copper mines in the world is down. We don't ignore these prices. Dr. Copper, it's the smartest commodity and tends to reflect economic activity. So we just don't know how much is a supply side problem right now versus increased demand. Here are some of the market indicators that strategists have focused us on. So negative strategists have focused us on the S&P relative to gold. Gold has been going up, and you can see recently it has been going up relative to the S&P. And they would point us again to the 70s. This is the last time that this metric based in this way, and the resolution was very negative. It was a highly inflationary environment, big deficits, both trade and government, and many fear that that's what we are going to face. We do not agree with that. One of the reasons we don't agree with that is on the next chart. This tends to be a leading indicator. This is the S&P to crude oil, and the S&P is going up relative to crude oil. You can see in the 70s what happened to this one. It based and then collapsed. So this would say all clear. And here is the 10-year Treasury yield. Again, is it levitating because of governments and foreign investors pulling out of the U.S.? Perhaps. But if truth does win out, we think that these long rates will come back in a bit, at least until next year, when it is clear, if we're right, we're in a very strong expansion. This is a measure of risk, and it's saying, no problem. This is the high yield spread relative to treasuries. And when it's low, it says, no problem, very few risks out there, nothing to worry about. But as you can see, it's low until it shoots up. And we do worry about private credit and private equity. We think there's a lot of disruption in old, mature companies. And if private credit and equity have levered them up, there are going to be some real problems out there. And that's going to be in the old world, not in the new world. It is going to be because of the new world, which is all about innovation. And then I'll end here on Bitcoin to gold. So the uptrend of Bitcoin relative to gold, despite recent performance, has not been broken, at least not yet. We're very bullish on Bitcoin, as you know, longer term. But gold is very recently has given it a bit of competition. We think they are both plays, if that's what investors or speculators are betting on here, on the debasement of fiat currencies. And we think that both of them ultimately are going to rein in the monetary policies that have been unhinged for the last 50 years. But that will take time. Anyway, that's it. I know this was long, but I think as I've gone around the world in these last 5 weeks, and I mean around the world, I've gotten a real sense of, how much pessimism there is about the United States. And being an insider, not an insider in terms of the administration, but just really watching policies and analyzing them instead of reading headlines, I can tell you, I think the surprises are going to be on the high side of expectations in terms of activity and on the low side of expectations in terms of inflation during the next few years. And I'll end on China here. We've gotten a lot of questions about China. And we post our trades every day, so as many know, we've been tiptoeing back in, really focused on AI and autonomous mobility specifically. We had pulled away completely starting in November of 20, when Jack Ma was banished and other leaders were forced out, and education or online education was nationalized, and gaming was shut down, and so forth. So it took a lot for us to start moving back in. The first clue that we had that something might be changing out there was about 18 months ago, roughly, when President Xi Jinping started shifting his focus from common prosperity to new productive forces, which is very much about technology. And China is really good when it comes to technology. We're seeing it in robotics. Maybe they haven't gotten there in chips yet, but I think they might get there. They've certainly imported a lot of talent back from the United States. In the early days, I remember I went to China in the 90s. They imported a lot of talent from TSM. So they have been building this capability for some time. And I do think they're going to be a force. And the question for us from an innovation point of view is, are they going to commoditize everything, take all the margin out? And very recently, you've heard President Xi Jinping talk about anti-involution, stop turning in and commoditizing everything and destroying the profit structures out there. It was okay when they were competing with exports, but now they're destroying their own industry, especially the EV industry, internally. And then very recently, he was much more explicit, or one of his deputies was, and basically said, hey, EV space, stop destroying the pricing structure. We will have no industry if you keep doing this. Okay, now we're talking. So that's just a little glimpse at what's moving us back towards China. And I would say the other reason is, again, President Trump might, don't know if this is true, but might be able to pull off another Nixon in China and get a really good, fair trade deal, more of a win-win. So it seems to us like that probability is rising, given the few things that we're seeing in those negotiations. So with that happy thought, I will leave you, and hopefully next month, we will have employment statistics once again. So thank you.